And that gives you what?
Profit for the year.
All right, we'll revise the format of vertical format, which will be tested in the exam, which will be useful in the exam. So you have it, the heading is always income statement. For the year ended, could be anything, right? For the year ended, let's say 31st December 2000, anything, right? That's the heading mostly. And then we have 3 columns most of the times. We have 3 columns, okay? In one column, you will basically do sales minus cost of sales. In the next column, you will do cost of sales. And in the third column, you often calculate purchases. Now, there's no such rule. It is just for our convenience. How do you find gross profit? You do sales minus cost of sales. Okay. Sales from which we might have to subtract any sales returns, right? Remember, instead of sales, you're going to write revenue. Actually, that one is preferred. Revenue is preferred. Revenue minus sales returns. Now, you see, are we going to do that in that column? No, we're not. What we will do is we'll do it in the second column for calculation, and we'll transfer like that. The net value will go here, right? So we've left this last column for sales minus cost of sales. You get it? Now, you see, cost of sales is not straightforward. What is cost of sales? Well, it has a few things. Cost of sales.
Right column, yeah?
What's that again?
The total comes in the most right column, yeah?
No, what's that again? I don't get it. Sorry.
The total comes in the most right column.
Oh, yeah, you're right. So if we have any sub-calculation, you're right. Any sub-calculation, like within a calculation, we have a calculation, we go to the next column. So now, for example, cost of sales, you know how we calculate that? We do opening inventory plus purchases minus closing inventory. Okay, good. We are using same column.
Less,
The total
less
we transfer.
closing.
We'll come to that. Opening inventory plus purchases, but you know what? The problem. Purchases has its own calculation. We have purchases minus purchase returns. So that is subtracted. Minus goods for own use, right? Goods for own use if owner takes them. Because that reduces your purchase, right? Purchase means goods available for resale. That will reduce the cost of sales. Own use. And we add any carriage charges, carriage inwards.
Inward.
Any carriage inwards only, not the outwards. Outwards is an expense.
Yes.
That's part of purchases. Remember, opening inventory is also part of cost of sales. Yani this year we sold some goods. What was the cost of those goods? Well, the opening inventory, the inventory we had from the last year is also part of the cost of this year because it was not used in the last year. It was used this year. So that's part of cost of sales. Opening inventory plus purchases. Once you find that net purchases figure, what are you going to do? Take the net.
Closing inventory.
Put it here. Right, exactly. Opening inventory plus purchases minus closing inventory, which is, closing inventory minus.
You can say less closing or
You
only.
can write less, you can write minus, it's up to you. Less closing inventory, you subtract that, and you will get your cost of sales. You see, opening inventory plus purchases minus closing inventory gives you your cost of sales. And now that cost of sales can now be subtracted from sales. You see how the direction went? This is what we needed to do to find the gross profit. This is your gross profit. And that whole section is known as trading section of the income statement. So this is what you needed. For this, you had to do one formula, sales, cost of sales. But within that, you had to make more calculations to find cost of sales. Opening inventory plus purchase minus closing inventory. But for purchases, you had another calculation. So you see, as we have another calculation, we're going backwards into another, column, the next column. You really need to get used to it. At first, it may seem difficult, but it's really not. Very easy to remember. That's our trading section. Continuing with the trading section, we start with the profit and loss section where we calculate our actual profit or loss. which is later transferred to the capital account. If you notice, there are no debits, credits over here. This is your the vertical format. It does not have debits and credits. It's just a list with calculations, right? In a horizontal format, we have debits and credits. You'll be using this one in the exam, but you know that concept. You should know that concept of horizontal one. To the gross profit, we add other income. What is other income? Example of other income would be rent received, commission received, discount received, right? Any receivables, anything that you receive from out of your normal course of working or normal course of trade. Well, we are making an income, we're making sales and all that, but other income is, besides your regular activity, you're earning something like rent or dividends, any sort of dividends, any kind of income, other income that you make will be added to gross profit. Well, if there are a few of them, you do the calculation here. Maybe there are multiple. You add them up, put it here, add it to the gross profit. Less expenses. Again, there'll be multiple of them. There'll be a whole list. What are you going to do? You list them all, rent paid and electricity and this and that, and you will total that and transfer to the last column, which will be subtracted from the gross profit. Sounds good? Gross profit plus other income minus expenses. And that gives you what?
Profit for the year.
Profit for the year, right? That's profit for the
Yes.
year. And if your expenses are greater than your gross profit plus other income, it's going to be loss for the year, right? Sounds good?
Yes, sir.
Okay, that's where your income statement ends. We call that profit for the year. Very important, right? This explains the whole income statement concept. Hope you'll remember that.
Yes, sir. The vertical one.
The vertical.